Hi everybody and welcome to today's webinar. I'm Terry Ryder, founder of hotspotting.com.au, and today we're going to discuss a range of property market issues with a common underlying theme of depreciation. Our guest presenters today are Tyron Hyde and Peter Folds from the nation's leading experts on depreciation, Washington Brown. Now, if you've had trouble getting your head around the concept of depreciation of houses and apartments, you're not alone. It's probably puzzling for many investors that the value of their building is depreciating in value at a time when property values are rising so strongly across Australia. Property values are up more than 20% this year as an average across the nation, according to the latest data from CoreLogic. And we're going to be looking at some statistics from Washington Brown and where investors are most buying. We'll also focus on what Tyron Hyde describes as the 7 crazy facts about depreciation. So firstly, welcome Tyron and welcome Peter.
Thank you, Terry. Thanks for having us.
Thanks, Terry. Always a pleasure.
Yeah, just before we get into the first of our topics, perhaps one of you guys would like to tell us a little bit about Washington Brown and in essence what you do.
Peter?
Yeah, sure. Terry, as you mentioned, Washington Brown, we're proudly one of Australia's leading quantity surveying firms specializing in tax depreciation. Very proud to be one of the most trusted in the industry. So Washington Brown have been around for over 40 years now. We've got 25 years specializing in tax depreciation. As many will know, but some might not. Tax depreciation is all about claiming essentially the wear and tear of a property, of an investment property, an income-generating property, as a tax deduction each year. And the deliverable, why accountants, property investors, developers choose Washington Brown is our deliverable is a report that guarantees our clients are claiming the absolute maximum ATO compliant tax depreciation deductions each year. So that report helps them, minimize their taxable income and maximize the tax savings.
Okay. So, Tyron, in the course of the work that you and your team do, doing depreciation schedules for investors across Australia, you've become aware of, through the statistics that you gather, exactly where investors are focusing their attention, where most of the buying is happening.
Well, we've got such a big database, Terry. We do actually have a lot of data on where people buy, and we've analysed it this year. And I guess you're the analytics guy, but when I look at RP data, we don't often get now where actually the investors are. Is it where we actually see where people are actually buying investment properties? We have such a big database, we can analyse that over the years.
Okay. Yeah, so it's interesting to actually look where investors are focusing their attention. There's still a lot of focus on Sydney. And that's what your figures show, despite the increasing issues about affordability. Obviously, Australia's most expensive city, but also the city that is showing still fantastic capital growth. So it's not surprising, perhaps, that there is a focus by investors in buying in certain parts of the Sydney metropolitan area.
Well, isn't it amazing, though? I remember we had a webinar about a year and a half ago, and it was minus, the forecasts were going to be negative 30% from the banks. What a turnaround. It's unbelievable. I can't remember a time like this, can you, Terry? Where it's been such a...
No, I've been doing this for almost 40 years, researching and writing about real estate, and I haven't seen a market like this one. I don't think we've ever had one, because we're dealing with unprecedented circumstances. And what's ironic about it is the media keeps saying that prices are rising despite the pandemic, but actually when you understand the forces in the market, it's actually, the reality is that prices are rising because of the pandemic, because the COVID-19 situation has unleashed forces, including government stimulus and a whole lot of other things, that are actually directly pumping up the market and causing prices to rise as much as they are. So it's really, it's because of COVID-19, not despite it.
And the interesting thing is with the RBA, yesterday saying that they're not going to put up rates for a minimum of 3 years. That doesn't indicate the market going down to me very soon.
No, look, I think this upcycle has longevity. I would perhaps expect that the rate of price growth has to moderate at some point. It can't keep going at quite these these incredible rates of rise, but I think prices will continue to rise well into next year, maybe beyond, because there's so many factors pumping up the market, and it suggests to me that there is going to be longevity.
Yeah. Yeah.
So Peter, you've got some slides to share with us to talk to some of the key areas where investors are focusing at the moment.
Yeah, so it's I guess just a brief look at some of the statistics, the numbers of where of the reports that we were engaged to prepare in last financial year. You know, at your suggestion, Terry, a very interesting look at where were the bulk of those located. Where were the local government areas where investors were buying? So I thought I've just prepared a couple of slides so we can look at those together. So I'll just share my screen now. Okay, just bear with me. Okay, so in last financial year, of the properties located within Australia, Washington Brown prepared just under 16,000 reports for investors whose properties were within Australia. So of those, the top 10, looking at the top 10 LGAs of where those properties were located. You know, before we dive into the actual where, I thought it was interesting to see that of those top 10, 4 of those, the most popular LGAs were in New South Wales. As I guess we'd expect, Terry, you know, 3, the next highest state was Queensland with 3. Victoria had 2 LGAs in the top 10. And ACT is an interesting one because the ACT government sort of have a slightly different approach to LGAs and how they sort of divide it up. It's sort of a bit difficult to split it up into individual areas within the ACT, but collectively, ACT as a whole did make it into that top 10.
Yeah. So there's a nice spread, particularly across the eastern states, and yeah, it doesn't surprise that New South Wales might be the leading state, but Queensland is also very prominent. I think we're going to see more of that as we go forward.
Yeah, I'll hopefully if we behave ourselves and perform well enough on the webinar today, Terry, you'll invite us back for something similar in a year's time. It'd be very interesting to compare the figures and to see the change, I think.
Okay.
All right. So looking at the individual LGAs themselves, you can see here that Parramatta City LGA in New South Wales was the top. Now, this number here is the percentage of our total reports of that just under 16,000 number that we did, just to give an indication of how close some of them were and the volumes involved. So you can see here at the top, City of Parramatta, then Bayside LGA in New South Wales, because I believe there's also a Bayside LGA in Victoria as well. Then you can see the Brisbane City LGA features there, followed by Blacktown and then Sydney City as well. After that, we start seeing the Victorian LGAs come into it. Melbourne, Wyndham, you can see Gold Coast, ACT, as I mentioned before, and then Moreton Bay as well.
Yeah. Like, it's interesting to see the breakdown. Firstly, it's just pretty interesting to see that the City of Parramatta, it comes up top, but perhaps not so surprising. One of the things that's come out for us, we've recently done a lot of analysis. We do a quarterly report called the Price Predictor Index, and to prepare that report, I analyse sales volumes, price data and vacancy rates for every significant town and suburb across the country. And when we're doing the Sydney part of that analysis, what we notice is that there's a lot of areas around Sydney which offer, I guess, a degree of affordability, as well as good infrastructure, good amenities, good locations, are the ones that are really standing out. And the City of Parramatta is one of those, because in Sydney terms, it does offer affordability. I mean, it's part of that strongly emerging Western Sydney economy, now one of the top 3 or 4 economies in Australia. Got a lot of major employment nodes, in this area. A lot of economic growth is occurring, but at the same time, a number of suburbs where you have median house prices perhaps just a little bit above $1 million, which in Sydney terms is below average.
Isn't that crazy? But yeah, that's now the new affordable, right? Or
well, that's right, and we're going to talk also about Blacktown, which is also even more affordable. But you know, we've got suburbs like Parramatta itself, median house price 1.1 million, Ermington 1.3 million, Lidcombe 1.2, Guildford at the cheaper end of the suburbs in the Parramatta local government area, 840,000. But also, you know, media always talks about our houses, and even when talking about Sydney, it tends to ignore the apartment market, which is a huge chunk of the dwelling market in the greater Sydney area. And when you look
certainly in Parramatta too, yes.
Yeah, absolutely. And I think one of the reasons why we get so many people focusing on Parramatta, both as home buyers and as investors, is that apartments are at, you know, a greater level of affordability. There are some suburbs where median prices for apartments are in the 400,000s, others in the 500,000. Parramatta itself is just a tick over 600,000. Maze Hill a little bit below 600,000. Carlingford is 700,000. Rose Hill, median price around about 500,000 for apartments. So in Sydney terms, there's quite a few affordable options for various types of buyers. So I think that very much explains why we might see this big focus on the city of Parramatta, while offering, you know, a very high level of amenity, good infrastructure, pretty good location, and an economy that's rising. And when we analysed sales volumes for the various suburbs throughout the Parramatta local government area, we find that, for example, Carlingford, sales volumes for the last 4 quarters have risen very strongly, quarter by quarter. We're seeing that pattern in other parts of Sydney, but very much evident in the city of Parramatta. So not a total surprise that it features so prominently in your figures.
And I'm sure many of those factors will apply to, you know, other areas. I mean, you know, here's this one is looking at Bayside.
Yeah, and I think it's a similar argument. Bayside is, you know, a pretty good location, apart from being fronting a bay, which is always a favourable aspect in the Sydney market. It's not that far from the CBD of Sydney, and yet you have a range of suburbs where, in Sydney terms, housing is fairly affordable. Includes suburbs like Brighton, Les Sands, median price 1.6 million, Rockdale 1.3, Mascot, very popular suburb and close to the airport, 1.5 million per house. But again, when you look at apartments, median prices tend to be in the 600,000s and 700,000. So again, a good location, good level of amenity, and some level of affordability for people.
And now a break in the New South Wales dominated LGAs. Yeah,
Brisbane. You know, it doesn't surprise me that the Brisbane features so strongly. And as you suggested, we come back and do this again in 12 months' time. Probably Brisbane will be even more prominent, because I think Brisbane's time to shine has certainly arrived. It's a market that's just been meandering along for the last, say, 8 or 10 years, but the next 10 years are going to be much stronger for a whole host of reasons. The population data massively favours Southeast Queensland. It benefits from the affordability comparison. It benefits from the relatively strong and successful control of COVID, to date at least.
Yes.
Infrastructure spend is greatly elevated compared with what was happening in previous years in Brisbane. That's a very influential thing. And of course, now we've got the icing on the Brisbane cake, which is the announcement about the 2032 Olympics. And what we know to be true is that the impact from an event like that actually comes in the years leading up to the event, in terms of the impact on real estate, more so than after the event. So I think Brisbane is going to be a place where a lot of people are going to want to own real estate. And so it doesn't surprise that it's so prominent in your figures, but I think it's going to become even more so.
I think as well, Terry, would I be right in thinking that, you know, in the lead up to the Olympics, we'd also see that expansion or that prominence extend to the neighbouring or surrounding LGAs as well? You know, I'd be expecting to see a lot more of in later years leading up to the Olympics, a lot more of the Queensland LGAs around the Brisbane metropolitan area.
Brisbane's unusual, isn't it? Because whereas Sydney and Melbourne is carved up into many dozens of different smaller local government areas, the whole of Brisbane is covered by just 5 municipalities. Brisbane City is a big chunk of it. And then around that, you've got Redland City in the eastern area by the Bay. You've got Logan City in the south, Moreton Bay region in the north, and Ipswich in the southwest. So just 5 local government areas. But those other local government areas that help Brisbane City make up the greater Brisbane area have an even greater level of affordability. So you can buy good solid houses with median prices in the 300,000 and 400,000, in some cases out at Ipswich City in the 200,000. So investors looking for affordability, superior yields, and also keeping in mind that the overall vacancy rate for Brisbane is a tick over 1%. So very tight rental market, very good time to be a landlord in Brisbane. All of those are factors that will attract buyers. I think we're going to just see increasing levels of demand for people buying in various segments of the Brisbane market going forward.
So Terry, next on the list was Blacktown, LGA in New South Wales again. I imagine pretty similar factors going on as the appeal with Parramatta.
Yeah, but even more so, because even greater level of affordability, but also that extra factor of big infrastructure spend. I think Blacktown's a great area to talk about, because I keep coming up against people that have this attitude that one of those old fallacies of real estate, that you've got to buy in the so-called prime areas, the expensive areas, to get the best capital growth. Well, Blacktown's living proof that you don't have to buy in the northern beaches or the swanky eastern suburbs of Sydney to get really good uplift in your capital values. Blacktown's been performing strongly for the past 10 years or more, and so their long-term capital growth rates in the various suburbs are 7-8% per year typically, which is amongst the best in the nation. Blacktown does offer great infrastructure and an intersection of major motorways, rail links. There's big university campus, major hospitals, big investment in infrastructure by the state government. You've got the new airport happening out there. If you believe, as we do, that influential, one of the most influential things is an infrastructure spend, then this is one of the places to be. And clearly investors believe that also, and attracted by the relative affordability. So you've got a number of suburbs with median house prices still in the 600,000, some in the 700,000s, and of course apartments cheaper still. So yeah, really very much targeted by not just investors, but also first-home buyers and other owner-occupiers seeking affordability.
And I think as well, if you're looking for land, if it's as much about having the backyard or a bit of space for you as it is affording the something and the location. Certainly, you can see on the map here the LGA boundaries marked out. Certainly in that sort of northern side of it towards Rouse Hill, the amount of land that money gets you is also, I think, very, very appealing in that region as well.
It's very interesting talking recently to buyers agents operating in various parts of Australia and some that operate in Sydney and Melbourne, a report that increasingly buyers are wanting to buy homes with a decent backyard. That's sort of against the trend. We're moving increasingly to houses being built on smaller and smaller blocks of land for affordability reasons. But buyers, it seems, according to the anecdotal evidence, are increasingly looking for a home with a decent backyard. And it's a response to the lockdowns and the restrictions. They want somewhere where the kids can run around, because they're restricted increasingly and repeatedly from taking the kids to the local parks. And so it's really influencing people's desire to have homes on a larger block of land.
Having a 2-year-old that's been at home now for 11 weeks, I can certainly empathise with that. So, Terry, if we move on to the fifth on our list, that I might get your feelings and thoughts toward the Sydney City LGA being so high on the list.
Yeah, I mean, it's a market that's been adversely affected more than most places by the various impacts of COVID. Now, many of the impacts on real estate markets have actually been positive ones, ironically, but inner Sydney has been impacted by higher vacancies because the students can't operate as normal, and international tourists who might be using Airbnb apartments, that's been cut off, so vacancies have been higher. But one of the things that mean in some cases prices have fallen, and there's a better level of value for money for people seeing an opportunity. But at the same time, we've also got suburbs like Darlinghurst, which have become increasingly popular, and we've seen the level of sales in Darlinghurst just increasing quarter by quarter, and prices rising quite strongly. So, suburbs like that, offer a certain lifestyle. Given that it's right on the doorstep of the CBD, surprisingly affordable, and so it really does offer things for people who, that's where we want to be, and we can access an apartment for a pretty affordable price and access that sort of inner city lifestyle.
Yeah, it makes sense. It's funny to be very interesting to see the longer terms of the COVID on the property situation. You mentioned that some of the prices have come down. I wonder, this concept, and Tyra and I were discussing it the other day, this concept of a CBD, the central business district, and that driving the demand for properties closer and closer to this CBD where we had to be for work, or where we had to commute to for work. And I certainly wonder what effect, or it'll be interesting to watch what effect that has, as this sort of notion of a defined CBD kind of, I think will dissolve a bit now that we're all working efficiently from home, or the vast majority of us. So that'll be interesting to see as well.
Yeah, well, I think proximity to CBD has always been overrated in the minds. Some people think closer to the CBD, the better the growth, or more important, the suburb. I've never believed that to be true. Increasingly, as we move forward, not just because of what's happened with COVID, but even before that, the importance of the CBD was diminishing. The reality is that, in Sydney and Melbourne, maybe 20% of the jobs are in the CBD, which means 80% of the jobs across the metropolitan area are elsewhere. They're in big suburban jobs most. Now, we talked about Blacktown. Well, Blacktown's a massive area for huge employment nodes,
Sure.
Big commercial industrial complexes, particularly out where the motorways intersect, for example, out around the east.
Huge warehousing spaces out there, massive facilities. So.
Yeah. And I think it was a KPMG, perhaps, who sort of has regularly done reports talking about the economic centre of the major cities. And every time it does that, the economic centre for Sydney moves a little bit further west each year that they do it, further away from CBD. So CBDs will always continue to be important, of course, for various reasons, but as time goes by, their importance does diminish. And now with COVID, with more people working remotely, and there's more and more evidence to suggest that is going to be a permanent factor, because it wasn't actually caused by COVID. I know media sort of represents it as being a response to COVID, but in actual fact, it was a trend that was underway long before we even heard of COVID-19. That it's a response to technology and the ability to work remotely, and more people are making that choice. It's being sped up by the lockdowns, of course, as more and more people have realised that they can actually work efficiently, and for some businesses, it's a huge benefit for them to have a certain percentage of their staff at least working remotely in some form.
Yeah, I think Tyron would agree, where Washington Brown would be in that category as well. Businesses have had to evolve, but sort of have done so successfully.
Yeah. So Peter, we've sort of covered the top 5 on your list. We should perhaps move on to the topic that Tyron's going to talk about, because we're sort of halfway through the allotted hour.
Sure. Before I hand over to Tyron for the main event and give up the limelight here, I just thought quickly, and we won't go through each of them, but you might not know, Terry, many people don't know, Washington Brown are one of the only firms trusted with preparing depreciation on overseas properties. So Australian taxpayers that have got investment properties located outside of Australia. And while I was compiling these, the previous stats, I was able to produce this, which I thought was interesting at a snapshot, just to show that, in addition to the 16,000 reports we've done for Australian properties, there are also 132 that we did for clients with overseas properties. And just an interesting breakdown to see that the vast majority of those were located in the UK. And whether that's, Australian citizens purchasing over in the UK, or whether it's UK citizens that own property then migrating to Australia. I thought it was pretty interesting to see how many are purchasing properties overseas.
And who was the lucky staff member who got to prepare the report for the property in Poland, for example?
No, well, we can't go to everyone, but it's amazing how many people put up their hands to do inspections in Bali, Terry.
Okay, yes, that's a little bit more understandable.
Yeah.
Okay. Well, look, Terry, thanks for that. Tyron, I'll hand over to you if you want to share your screen.
I'll just share my screen. But firstly, I just want to apologise everyone for my hat. But, we are in a situation where it's very hard to get a haircut. And so that's why I'm wearing a hat. Okay. It says you cannot start screen while someone else is sharing theirs.
Okay, well, there you go.
Okay, let me share my screen.
While he's just sharing his screen, there's one question that's come through, and I do encourage everybody out there watching and listening to please type your questions into either the Q&A panel or the chat box. And one question that's come through: what does LGA stand for? That's the local government area. We've been talking about LGAs in terms of locations where investors have been prominent, as shown by the Washington Brown figures. LGA stands for local government area or municipality.
And that's my bad. It's funny how you get so caught up in the particular jargon of an industry, and so I've just jumped straight in there by speaking about LGA. So I apologise. Yeah, as you said, stands for local government area.
Okay.
Okay.
So Tyron,
that screen now.
Yeah. See your slides.
Excellent. All right. So just backtracking. Thanks for everyone for coming. My name's Tyron Hyde. I'm the CEO of Washington Brown. Washington Brown Quantity Surveyors, as we said, and we prepare lots of depreciation schedules all around the country and the world now, as Peter pointed out. And so what do quantity surveyors do? Well, in summary, we work out what things cost to build. That's our skill set. So what is property tax depreciation? Well, depreciation is the legal wear and tear of an investment property that you as a property investor can claim. The property must be income producing. You can't claim a depreciation deduction on your house. And the bulk of the depreciation claim is based upon the actual construction costs of the property. So where the costs are unknown, the ATO will accept a report from a quantity surveying firm like Washington Brown, where we estimate the original construction costs. And that's the key here. We have to base the depreciation schedule on the original construction costs, not what it costs to build today, unless it's brand new. We are recognised by the ATO to accept that they will accept one of our reports. And so why do you care as a property investor? Because whatever we produce as a report, if we say that you can claim $10,000 in depreciation in the first year, that comes off your taxable income. And in summary, you pay less tax. Now, the laws have changed. In 2017, there was a major overhaul of the depreciation system. It was, in my opinion, rushed. The Treasury Department asked for my opinion, and I gave them some advice on what they should do, and they completely ignored it. But let me explain what happened in the good old days. So we used to go around to every property, regardless of its age, whether it be a brand new property, a 2-year-old property, or a 100-year-old property, and we would value the plant and equipment within the building. Now, that's the plant equipment are things like ovens, dishwashers, etc. And we would put a value upon that based upon what you paid for it. For, similar, if you were owning a business and you bought a second-hand computer for $500, well, that's the value that you paid for it, and that's the opening written down value of the computer. That's the first component of a depreciation report. The other, that's the plant equipment that I'm talking about. The other component is what's called the building allowance. That's the structure of the building. That represents about 85% of the construction costs, and that's where you claim the construction costs over a 40-year period. So to put that in perspective, if I was to build a house today for $200,000, and that was the Section 43 allowance, the structure, the brickwork, the concrete, I would get to claim that over 40 years at $5,000 per annum, a flat line. That's the structure of the building. Nothing has changed in that regard. So the 2000 budget came along and changed the game for property investors. It was a shock to the quantity surveying industry, let me tell you. And I was getting a lot of calls saying, what the hell is going on? So what they did was, since 2017, they've denied income tax deductions for the decline in value of previously used depreciating assets. So the moment that you buy a secondhand property, regardless of whether it's 1 day old or a 50-year-old property, you can no longer claim the depreciation of the plants and equipment in the building. They consider that now previously used. That's the ovens and dishwashers stuff. So even though the oven might be 1 day old and the tax office says it's going to last for 10 years, the moment that it becomes secondhand, you can no longer claim that asset. They said it was an integrity measure to address concerns that some people were overclaiming these values. And they had, in some regards, they were right, and I agreed with them. I think it was a bit silly that we could go out and revalue something that was 50 years old and continue to claim that. But however, to come along with a sledgehammer and say the moment that something's 1 day old was, in my opinion, a bit rushed. And I'm going to run through some of the crazy situations that have occurred because of this integrity measure. So a quick recap, what did they do? So the government said that new property hasn't changed. So if you buy brand new property, you can still claim the depreciation of the plant equipment and the building allowance. Now, why do they do that? Because a lot of development relies on pre-sales, right? And a lot of developers use the depreciation numbers to make the property look far more attractive, to get off the plan sales. And the construction industry is kind of a leading indicator of how much GDP will occur within the economy, right? They say that for every $1 spent on construction, it leads to $10 throughout the economy. That's the HIA saying that. They're going to pump it up a bit, but it's got to be some truth in that. The second thing they did was they said, okay, this only applies to residential property. Offices and industrial, no change at all. So you can still go around and claim a 50-year-old air conditioning system in an office, but not in a residential property. They didn't change the allowance in terms of claiming the depreciation on the bricks and concrete. That, as I said before, that represents about 85% of the cost. So regardless if it's secondhand, provided it's built after 1987, you can still claim the structure of the building, which was a good thing. They still allowed you to claim if you installed something. So for instance, if you were to buy a secondhand house that's 1 year old, you can't claim the oven and dishwasher anymore. But 5 years' time, when you replace that oven and dishwasher, you buy it brand new, of course you can claim it. Good name for a book, claim it. I wrote one like that. Anyway, entity changes. So they said this only applies to individual taxpayers. So companies, so if you buy a property in a company name, you can still claim the depreciation on a secondhand property of the plant equipment. If you're a large super fund like Uni Super, you could buy 100 secondhand properties and still claim the depreciation on the plant of equipment, but you or I, as an individual taxpayer, can't. Similarly with large trust funds, Macquarie Bank could package up 1,000 secondhand houses and claim the depreciation. Doesn't seem that fair to me.
So, Tyron, can I just ask a question about that?
Sorry?
Can I just ask a question about that in terms of entities? A basic trust that somebody like me might set up to own real estate, is that classified as a company or still classified as an individual?
Classified as an individual because you're paying the individual tax rate on it. So it all came down to the tax rate, and so the trust fund doesn't apply. It's only large unit trust where you have to have over 300 members to get around that. Unfortunately. Okay, the laws were grandfathered. So if you bought a property before 2017 and you were claiming secondhand plant and equipment, they didn't change that. So you were allowed to continue claiming the depreciation on the secondhand plant equipment. It's only properties that were purchased after the date in 2017. Overseas properties, you still can claim the depreciation on the building allowance, but it's provided it's after 1990. And as Peter highlighted, we do a fair bit of that work. Okay, I got the. Oh, wait a second. Okay, let me skip to my 7 crazy facts. Crazy fact 1. So as I said, buying brand new property, same day as this, you can still buy brand new property and claim the depreciation on the plant equipment. However, what happens if you were to settle off the plan a year out, right? You then sell it to someone else 6 months later, and it hasn't finished yet. So what happens then is you have what's called a dual settlement. The first purchaser will settle with the developer, and then you will settle with that subsequent purchaser. So because I didn't buy it off the developer, and the original purchaser isn't now paying GST when they sell it to me, I can't claim the depreciation on the plant equipment, even though it's brand new, even though no one's ever walked into the unit, no one's ever used the oven. It's not considered brand new for the purposes of depreciation now. That to me is a little bit weird, and I think should have been looked at. I can get why if they say it's a week old, it's someone has used it, but where it's the dual settlement, unfortunately the way it is at the moment, it's based upon whether the vendor paying GST. So I think I would, if that was my scenario, I'd try and get a private ruling. However, I can't see that it would occur because, but it does make a lot of sense to me when where someone hasn't even opened the door. It's considered not brand new. Crazy stuff number 2. Why pick on residential property? Why did the government only say this applies to residential property? Why can I still go out to as a quantity surveyor, go out to a factory that's 50 years old and revalue the motor on a garage door, whereas I can't do that on a residential property? It didn't make a lot of sense to me, and that's one of my arguments to them. Why are they picking on residential property? The Treasury Department felt that that's where the greatest amount of overclaiming was going on. It does make a lot of sense to me. Okay, crazy stuff number 3. Now, what happens is, I just got a picture of a high street property. And this happens, you've got you've got a retail shop down the bottom and you've got a residential property upstairs. Say they were both built brand new 1 year ago. This is obviously a little bit older, but let's say they were both built brand new 1 year ago. And you had the same flooring on the bottom retail level, and you had the timber flooring going up, the floating floor going up the stairwell into the residential apartment above. Now, if I were to buy that property 1 year, when it's only 1 year old, I would be able to claim the depreciation on the floating floor, that's exact same floating floor on the bottom level, because it's considered commercial. The moment it gets to the residential property, I can't claim that anymore. Doesn't seem right, does it? Similarly with air conditioning. What happens if we've got ducting that goes through, or the controls that control one on the retail level control, but you've got a separate control, but running on the same system above? I'll be able to use the controls. I'll be able to claim the controls on the bottom level of the retail because it's considered commercial, a commercial property or non-residential. But the control on the top level, I wouldn't be able to claim, even though that's both 1 year old, both working on the same system. Again, crazy stuff. Crazy stuff number 4, air conditioning. Now, this is even more complicated. What happened is when we now depreciate air conditioning systems, it's easy when it's a split system. It's just considered an air conditioning split system. However, when you've got ducted air conditioning, we now have to separate the air conditioning into about 7 different components, being switches, fans, and the ductwork. So the ductwork now is considered part of the building. So when it's brand new, a property, you're able to claim all the 7 items that air conditioning comes with, plus the ducting, which is considered part of the building. The moment that it becomes second-hand, I can't claim the plant equipment items of the air conditioning system, such as the controls and the fans, etc. However, of the same system, I can still claim the ductwork because it's considered part of the building. So you've got half of the system being able to claim and half not, even though it's 1 year old. Quite bizarre. Crazy stuff number 5. Bigger is better, they say. Peter would agree with that. He's 7'6". But in terms of depreciation, obviously the bigger is better, because if you're Macquarie Bank and you have and you package up 1,000 units, second-hand units, you're able to claim the depreciation. Or if you were to buy, if Uni Super were to buy 1,000 properties for their super fund, residential properties, they'll be able to claim it. But you or I, as an individual taxpayer, can't claim depreciation on plant equipment in a second-hand property. Okay, now, crazy stuff at number 6. This number 6 item, and I just did this myself, right? I owned an apartment that I've owned for 15 years in Bondi Junction. And prior to selling it, the tenant moved out, and I said, oh, you know what? Not a bad time to sell. I've seen worse times to sell property. I'll put it on the market. So before I put it on the market, I wanted to spruce it up. So I put on new carpet, I put in new blinds, I put in, what else did I do? Put in new carpet, new blinds, new lights, something else, the part and timber flooring. All plant and equipment items, all things that would be able to depreciate at a quicker rate than the building, some at 10 years, etc. So I put them in for the sale. Now, they've never been used. I'm just purely there benefit to, I guess, get me a higher return on the sale. Never turned on. When I sell that to that incoming purchaser, because it wasn't installed when they bought it, it wasn't installed by them, even though it's brand new and never used, they can't claim that. Second hand. Kind of bizarre. My funny, loveliest slide. Crazy stuff, number 7. Now, when the laws changed, I feel that some quantity surveyors are actually living in the past a bit. And because the laws have changed so much that you can only claim the depreciation on the plant and equipment in brand new buildings, there's lots and lots of buildings that quantity surveyors like Washington Brown have the actual costs on. And when I say they're living the past, some firms are saying that every property still has to be inspected. In my opinion, that's benefiting the firm telling you that, possibly not in your interest. Don't get me wrong, there's still lots and lots of properties that need to be inspected. But what we do now, instead of saying that every property has to be inspected, we analyse the property for you first and give you a depreciation plan as to whether it should be inspected or not. For instance, we have a lot of costs on buildings already. You know, we've been working for major developers for many years. And for instance, Meriton is one of our clients, and they built Well Tower. We've been to Well Tower 100 times. I've got the original cost, more than 100 times. And now that the laws have changed, the original construction cost has never changed. And I'll repeat that. The original construction cost never changes. And if we've got the original cost, why would we want to charge you to inspect that when it doesn't change? Nothing will change the original construction cost. So we came up with a depreciation plan, and COVID, I guess, in some ways forced this. I'd been thinking about doing this for a long time, just telling people, well, you know, the laws have changed. We've got the cost. And then COVID forced this a bit and I don't think we're the only business that when COVID hit said, let's reanalyze our business and let's see what, if I was to shake it up and re-look at it right now, what would I do differently? And I said, yeah, well, you know what? We would actually tell our clients that in this case, it's not in your interest to get an inspection because we've got the cost and we'll pass that saving on to you. So where we have the actual cost, we analyze that first and we tell the clients, well, we've got the cost, you benefit. And so it's been a bit of a win-win situation in that regard. But don't get me wrong, there's still lots and lots of properties we inspect. We have to inspect every industrial or non-residential property because you can still claim the plant and equipment on the second-hand property. But where we've got the cost, we're not going to charge you a fee that's unnecessary, in our opinion. So look, yes, it's the way that the law, in my opinion, was a little bit rushed. I did, as I mentioned, get asked by the Treasury Department to go in and give my view, and I wrote them a very detailed response on what I think they should have done.
And polite. It was polite.
It was polite. It was very good. I was one of my proudest moments, to be honest, getting invited to discuss it. But in reality, all they were doing was ticking the boxes in regards to having industry consultation. They'd already made their mind up.
Yeah. I think your problem, Tyron, is you're expecting these decisions from politicians and bureaucrats to actually make common sense.
Yeah.
I don't think
so
that was.
What I suggested to them was quite simple, really. I said, well, instead of just saying and having a sledgehammer approach of saying that the moment that the property is secondhand, you can no longer claim the depreciation on a plant and equipment item when you give it an effective life of 10 years. So to put that in perspective, when you buy a brand new property, the carpet has an effective life of 10 years. That is, it's going to last for 10 years. And if you were to buy it brand new, and held it for 10 years, you would claim the depreciation for the whole 10 years, right? But the moment you sell it after 1 year, you claim it for 1 year. And then if I bought that property, I can't claim, I miss out on the 9 years. No one gets to claim that. And I said, well, why don't we have a system where after, if the carpet was $1,000 and it's 1 year old, and it's pretty easy to track how old an apartment is, we have to value the carpet at $900 and that person just gets the next 9 years. And then if it's 5 years old, it's 5 years. There's no never ending write-off. It just maxes out its original 10 years. Pretty logical, but they'd already made up their mind. And they looked at me and they said, Tyrone, will what we're doing stop overclaiming of depreciation, full stop? And I went, yes. I said, it's a better approach, but I couldn't argue that it wouldn't stop overclaiming of depreciation. So, yeah, I was wondering if anyone has any questions. Am I allowed to ask the questions?
There are lots of questions coming through, Tyrone.
Okay.
And just apropos what you've just been presenting and saying, Ian is asking, so what are the solutions in the light of all that information? Is one of the solutions to buy property through a company structure, for example?
Okay, well, that has other issues. So I'd always say there that you need to discuss that with your financial advisor, because then you have capital gains tax issues there, so you won't get the benefit of the CGT discounting on a company. And so you really need to discuss that with your financial advisor. Financial advisors tend to say that it's not in your interest to do that. However, with company rates tax, when they're coming down, it may mathematically be an option. So it really depends on your income, like negative gearing benefits. So a lot of people buy property. Well, negative gearing is not such a thing now with interest rates so low, is it? So look, I would suggest that it needs to be revisited all the time, what is the best entity, and that's something you should discuss with your accountant, because it's subject to the negative gearing benefits, and that's subject to interest rates. It's subject to the tax rate at the time. So there are many questions within that question.
And apropos capital gains tax, there's a number of questions, and we always get questions on this point, and that is that you can claim depreciation for the time that you own a property, but when you sell it, does it get clawed back by the government?
Well, not the depreciation on the plant equipment anymore now on the secondary property, because you're not claiming it. What does get clawed back is the depreciation on the building allowance, and it's mathematically proven that it's better to claim that along the way, because you're getting it. You're offsetting your higher rate of tax if it's in your own name or a trust. And then when you sell it, hopefully you've held it for a year, and that gets discounted by 50%. So it is worth claiming the building allowance, and that's why.
So another way to look at that, Ty, we get throughout our day-to-day, Terry, we also get asked that question a lot, as you can imagine. And so I think it was Dilip, one of our viewers today, that was asking that question. Is, potentially when you're buying an investment property, for a lot of people, the aim is to hold that. Yes, you might be open to the possibility of selling that years down the track, but I would argue that it's better to be reducing your taxable income and benefiting from that increase in cash flow year by year, rather than holding off on a maybe we'll sell it, 20 years in the future. Benefit from those savings now, rather than holding on the if. So that's the first part. The second part I like to tell clients is, we're lucky in this country, as Tyrone said, if you've held that investment property for over a year, we're lucky enough in this country to have that 50% exemption when calculating CGT payable. So yes, even though you might have been claiming, $10,000 a year in depreciation deductions against the structural component remembering you do not have to pay back any depreciation claimed on the plants and equipment side. So if you've been claiming $10,000 a year on the structural component, theoretically, you're really only paying that back at $5,000, a year later on. That's a gross simplification of it, but you're still getting 50% of that benefit, even when you have to factor in that back if you do sell in the future.
Okay. So Vivian's asking the question, do you have any recommendations on whether I should apply PC or DV as a depreciation method?
Okay, good question. In most cases, people claim the diminishing value method because you get more upfront, and people want a deduction today rather than later. So most people claim that. The only reason where you would tend to use the PC method is, let's say you bought a, well, it's not going to work anymore. I was thinking where you lived in it for a couple of years, but then if
plant equipment.
So if you're really, I'd only say now there's really just a diminishing value method for plant equipment, because if you buy something brand new and lived in it for 2 years, in the old days you would want to claim the PC allowance after, because you can you're slowing down the depreciation. But now if you buy something brand new and live in it, well, you can't claim the depreciation thereafter. So if your item is brand new, use the diminishing value method, in my opinion.
Okay.
Important to mention that for accredited providers of depreciation services, obviously like Washington Brown, important to mention that our reports as standard come with both the DV and the PC methods there. So you don't have to decide that before engaging us. We're providing you with those figures in both. That's, you would talk to your accountant or, get the check to make sure which one is more appropriate to you. But certainly, as Ty said, if you're able to claim on the plant equipment component, the DV method's going to be better for you.
Okay. Christine is asking, what happens if I bought in 1996 and have totally renovated an investment property? Can I depreciate the build?
Absolutely. So the age there is irrelevant. Once you put in a brand new kitchen today, or it starts again. So that you won't be able to claim on the original structure if it's built in 1986, because it's a bit too old. But everything that you spend on it, you'll be able to claim a depreciable deduction on.
Okay.
It won't affect you.
So Pat is asking, if I buy a second-hand apartment in a single tower block of 200 apartments, can I claim a proportion of the building structure cost? If so, can you?
And the answer is yes. Again, provided it's built after 1987, it'll still be worthwhile. Yes. So when you buy an apartment, you own a portion of all the common property. You own a portion of the pool. You own a proportion of the lift. That's similar to how you pay your sinking fund or your any levies. It's based upon your unit entitlement. And if there's 200 apartments and every apartment's exactly the same, you'll own 1/200th of the construction cost of that apartment. It doesn't, of course, always work out like that. Strata levies, the unit entitlement of a building is not everyone is the same. That's subject to things like, they generally do it based upon the price. So the penthouse will have a higher unit entitlement than the lower level apartment. And accordingly, whilst the penthouse owns more of the building structure, they also pay higher levies and higher sinking fund costs.
Okay, so someone's asking, I bought a near new property from the DHA and they gave me a depreciation schedule. Are you saying I can't use it and claim the depreciation?
No, I'm saying that you can probably, I haven't actually got the report in front of me, but if it's secondhand, I'm saying that you should be only claiming the building allowance. If you bought this after 2017, you can only claim the depreciation of the building, not the whole depreciation schedule. So if they've said that if you bought this last year and it's secondhand, you shouldn't be claiming any depreciation on the oven and the dishwasher and all the plant equipment items. But I think your accountant would hopefully check that if you're using an accounting firm.
Okay. So there's a question here from Ram about New Zealand properties. You did mention you do quite a number of schedules for overseas countries. So New Zealand presumably is one of those.
Yes. Yep. Nine reports there last financial year.
Yeah. So is it possible in 25 words or less to summarise? Are there any significant differences there?
Okay, so when we're doing depreciation reports overseas, they're based upon the Australian tax law. So it's for someone who is still paying the tax in Australia. It's not, we're not going over to every individual country and saying, okay, the Polish depreciation rates are here, etc. It's for Aussie. Okay. So it's the Australian tax law we're doing. But in answer to that, well, New Zealand used to have the most lucrative depreciation laws and tax laws in the world. It was unbelievable. But obviously with such rising property prices over there, they have put a squash to how much you can claim. This is just from my general knowledge, but they have put a bit of a squash to how much you can claim in terms of the capital gains tax and the depreciation. Because it was just too lucrative. It was ridiculous.
Okay. Mark's asking a question. I don't know if this comes under the heading of depreciation in any way, but he's asking about sinking fund payments. If you're part of an apartment block, how do you go about claiming for that?
Okay, two components there. Firstly, so the sinking fund component, you should be claiming that every time that you pay the sinking fund or the strata levies. Your accountant should be claiming that every quarter that you pay that. Where it gets more interesting is if you were to have a special levy. Okay, so say you own a block near the beach, or you own an apartment near the beach, and it had concrete cancer, and you had to raise $100,000 per apartment as a special levy. Now, the law is that if you raise the money, you can only claim the special levy cost of that $100,000 at 2.5%. However, where it gets more interesting is if the strata body had foreseen this and had 2 years before or a year before raised the levies to $25,000 per year, not called it a special levy, or over 2 years, maybe like $12,000 per annum, per quarter, and had the money in the sinking fund already, then did the work, you as an individual be able to claim the whole of get $100,000 tax deduction, as opposed to raising $100,000 as a special levy and getting it at 2.5%.
Right.
Quite interesting.
Carl's question is, can we claim depreciation for a granny flat if it's built within a property that is over 40 years old under a trust held under a company name? That sounds a bit complicated, but do you get the essence of what they're asking?
No, I missed it. Sorry, say that again.
Can I claim depreciation for a granny flat if it gets built on a property that's over 40 years old?
Yes, absolutely. Good question. Provided the granny flat is income producing, right? You can't put it on your house, put your grandmother out the back and claim the cost of the granny flat. You have to actually rent it out and get market rent, and then you can claim the cost of the granny flat, even though the original building is 50 years old. Good question.
Okay. A general question from Dilip, just asking what is included under the general heading of plant and equipment?
Mm-hmm. So generally, it's items that are removable, easily removable, and have a smaller effective life than 40 years. To give you so things like ovens, dishwashers, range hoods, air conditioning plant, fridges, microwaves, TVs, all the stuff that you can, in theory, can be easily removed. What is in the other category, the building allowance, are structural things like concrete, brickwork, the roof. I'm looking around my unit at the moment. Tiling, windows and doors. They're the structural items. Okay.
Now we're just we've just ticked over for the hour, so we should probably think about wrapping up shortly. And there's let's see. There was a question there about, so I thought it was a good one to end on, and now I can't find it, but it's generally asking, how do people sort of reach out to Washington Brown if they want to follow up, ask further questions, or actually just go ahead and get a depreciation schedule done?
Sure. Well, yeah, thank you, Ty. To everyone, I've just put our email address in the chat forum here, which is info@washingtonbrown.com.au. There have been so many questions coming through, it wouldn't be possible to get through all of them, but we love getting asked the question. So I don't want those going to waste. Please email us with the subject heading hotspotting, so we know it was from this session. If you send that email you can address it to Peter or Tyron. Send it to info@washingtonbrown.com.au. So info@washingtonbrown, all one word, .com.au. Send questions to us and we'll get back to you as soon as we can. Costs nothing to ask questions. And I also want to stress, and this is a big one, if you've got an investment property and you felt that you've been told it was too old, that there are no deductions available, or if you haven't got a schedule done on your property, please reach out. We're not going to charge you to have a look into that and see how much you might be able to claim in depreciation. It's always free to ask the question. It just ensures that you're not leaving any deductions on the table. When we know it's come from a hotspotting session, Terry will also offer a discounted fee.
Yeah, and I just reiterate it. It costs nothing to ask the question, so please follow up and do that if you've got any uncertainty about it. But one of the things I would say is for the cost of a depreciation schedule, it's one of the best investments you can make in terms of what it costs to get the schedule and the return you get on it in terms of the taxation that you save over a period of years. It's a fantastic investment. So to those out there who've got investment properties and haven't done that yet, I really do encourage you to do it. Washington Brown does all the work for you. It's not something that's an onerous task. You really just have to hit the go button and they go and do it all for you. So for a very small outlay, you get a great return almost every time. So probably a good time to wrap up. Thank you, Tyron and Peter, for a really entertaining, and I mean, it's amazing how you guys can make what is perhaps a very dry subject interesting and entertaining every time. I always enjoy these sessions. There's always new stuff that comes up.
It's partly for yours and your viewers' benefit, and a lot to do with our sanity, having been doing it for so long. So,
and we're getting. I don't know if you can see the chat box and the Q&A thing, but lots of very, very nice comments coming through. Very educational. Well done. Thanks, everybody. Very informative, etc. So,
thank you. Yeah, thanks, everyone.
I'll just add my thanks to that. I think it's been a great session. Anybody would like to follow up, please contact info@Washington Brown. And there was a number of questions there which I kind of passed over, which were perhaps directed at me asking questions about locations. Feel free to email me if you want to follow up on those, ryder@hotspotting.com.au. So, Tyron, Peter from Washington Brown, thank you again. Let's do it again soon.
Yeah, sounds great.
Love to, Terry. Thanks very much. Thanks, everyone.
Okay. Over and out. Bye for now.
Bye.